All right. So we'll go ahead and jump in. Sarah, Simon, thank you for joining us today. It also looks like we have a great number of attendees. There's really positive feedback that this is a topic that's really relevant to business owners within this industry. I'm joined with Simon Lehmann, CEO of AJL, and Sarah Bradford, the previous owner of Winter Park Lodging and Steamboat Lodging Company. And today we're discussing building an exit-ready business. A little housekeeping before we jump in. This session is scheduled for 60 minutes. We are recording this session. We have about 40 minutes of discussion between the three of us, and then we're going to open it up for a Q&A session with our attendees. Along the way, feel free to add any questions that you have in the Q&A feature on the bottom of Zoom. One thing to just keep in mind, we have over 100 attendees to the session, so we're going to try our best to address all the questions. But we will be sending a follow-up email following the session with a recording, as well as some key takeaways from the three of us, and also just give you the opportunity, if you do have any questions that were unanswered, you can reach back out to us and we can schedule a time to talk. So without further delay, a little bit of intro on myself. My name is Jason Thomas. I'm the COO and co-owner of Raincatcher. We are a business brokerage and mergers and acquisitions firm based here in Denver, Colorado. Really, we specialize in helping business owners prepare and execute on an exit strategy, whatever that looks like, and everyone's exit strategy is different, whether that's now or in the future. And that's really what makes this conversation so relevant and why we brought Sarah in and why we have a strategic partnership with Simon and AJL. Raincatcher, we're licensed in with FINRA. What that means is we're able to do advisory services and capital raises in all 50 states. And our team of 25 is spread out throughout the country, and we have an industry specialization in short-term rental. So our guest today is Sarah Bradford. Sarah, like I said, is the previous owner of Winter Park Lodging Company and Steamboat Lodging Company. Not only did Raincatcher help Sarah exit from her business, we've also formed a great relationship. Sarah's become a really good friend, and also is just an amazing advocate for this industry. This discussion, I think, is it's relevant with Sarah because she did take the time to build an exit-ready business. She put in the hard work and she put in the thought to develop and execute on that strategy. And the end result is Sarah sold for a great value, and it also had a very smooth transition out of her business. Besides getting much better at pickleball, we've got a great reputation in pickleball, and being just an amazing skier, Sarah continues to give back to the industry, which I really appreciate. And one way she does that is by co-hosting with Tim Cafferty, the Sarah and T Show, which is a podcast that really is a thought leader for the short-term rental industry. Sarah, thanks for joining us. Really appreciate it. I think you're joining us today from Vail, where your kids are skiing in a ski comp, and thanks for taking the time. I know being retired a little bit, you have some extra time to spend time with your kids, but also to do things like this.
Thanks. Excited to be here.
Well, thanks for joining us and taking the time out of your day. And last but not least, a man that needs very few introductions, but I'll turn it over to Simon. Simon's the CEO of AJL and also our strategic partner in this industry.
Thank you, Jason. And also thank you, Sarah, for making your time. This is super exciting to have you on this webinar. And it's great to have you on the other side this time. Normally, I was on your podcast together with Tim, and now we have you on ours. So that's super cool. I see Tim is in the crowd as well. He's cheering you going forward, which is awesome. So yeah, my name is Simon Lehmann. I'm the co-founder and CEO of AJL Atelier. We're a consulting and advisory firm for short-term and vacation rental. We are working with any type of stakeholders within the vacation rental industry, from large private equity firms to technology companies, as well as property management businesses. We are truly international. Our team in the meantime has grown to 10 people. We do consulting work. We do financial support for companies who are potentially looking at improving their operational expenditure. We're helping on tech stack building. We have helped companies to outsource or insource laundry operations. So it's it's very diverse. We have worked with very large corporates to come to market. And for M&A transactions on the buy side and sell side, it's great that we have now in the United States partnered with Raincatcher. And that means we are able to expand our services with the network that we're bringing to the table. And it's great to have this webinar and bring this topic closer to the audience. I mean, it's something that has received a lot of momentum, especially with Vacasa being very acquisitive when they started to raise a lot of capital. But I think we're far beyond that, and the landscape has changed. So I'm super happy and looking forward to have Sarah here and share her story with us on all the things that you need to be mindful when making an exit. So we're glad to be here, and I'm handing over the word to Jason to kick our conversation off.
Great. Thanks, Simon. Thanks, Sarah. Excited to get started. So we wanted to start the conversation off today with really just the question of why are you in this business? And I ask this question because the typical response we get is, I love the industry. I love my team. I love making money. I love building something. I love participating in the community. Whatever that response is, it means a lot to the people that are the entrepreneurs. But the response we typically do not hear is, I'm in this to build a business to exit. And people don't, a lot of times, and this isn't, there are outliers, but a lot of time business owners are in the business because they fell into it, or they had a condo like Sarah did, and all of a sudden that turned into a business and it evolved. But the crux of the conversation is, okay, you're in the business, and then you get to a certain point and it's, okay, now what? What is that next step, and how do I get out of this? And Sarah, you had a funny little topic on the Truman Show, but walk us through that journey for you a little bit. How did you get into the business, and then at what point did you realize that you wanted to figure out how to get out?
Yeah, I like to say, if anybody's ever seen the movie The Truman Show with Carrey, what's his name? Jim Carrey. Yeah. There's that woman in the movie that wears that button that says, "How will it end?" And I always thought that for the last couple of years, how will this end? And I think we're all wondering sometimes. So I probably have been talking to my husband about selling our business for, I don't know, I'm going to say 4 years now. I would have a bad day at work and come home and be like, we're selling this. And then 3 days later, I'd sign on a new client and get all jazzed. And he'd be like, we're not selling it anymore, are we? No, I love it. And so I was sort of up and down about it for a while. And then right before COVID, actually, Jason, we've worked together since 2019. So over 2 years that we worked together before we actually sold. I just finally with my husband said, I'm 52 now. How will this end? And we went through a lot of soul searching. It's time to figure out what the path is. So we went through thinking about our kids taking the business over for quite a while, actually. And then I decided I wanted my kids to forge their own future. And they're only 15 and they were only 13 at the time. So that would mean I have to work on this for at least 10 more years. So that was out. Plus, if you sell it to your kids, are you really going to sell it for what you want to sell it for? And then you still don't have retirement money. Kind of decided no on that. Then we thought about, for a while, we'll just get me completely out of the business. Like I'm almost a board member and I'll just check in on it every month or, maybe once a month. I talk to the management. And we thought we'll just put some really high level people in the business so that I truly could walk away. That then, if you even think about things like that, it makes it more real. Like, could I do that? I found I just couldn't do that. It was not possible for me to just walk away and not see it, not pay attention to it at all. And then we really got to, okay, I think we want to sell it. What do we have to do to get the most money out of this? What should the process be?
I want to come back to one of the points that you've talked about just now, and one would be in terms of attractiveness and the options that you had to yourself, Sarah, in relation to even merging a business. Like you say, okay, if I go in with somebody who is equally big or even bigger, I can, have more. 1 + 1 in most cases in M&A is more than 2. Was that an option? And if so, what made you not to do that?
You're asking, did we think about joining with another company?
Yes.
We did. In fact, we talked to a few because we thought, well, you'll get more money if you make your company bigger, right? That's why some companies are buying many other companies, because they can build that up and sell it for a much higher multiple. So we talked to a few, but none of them were at the point we were at where we were ready to go. And also, to merge is a huge effort to then sell. So I wasn't frantic to sell our business, but at that point, when I decided we wanted to sell, if you told me it was going to be 3 more years, it was like, ugh. So we just decided not to do that. I mean, some of the people on this webinar might be thinking, I'm not ready to sell now, but I am in 5 years. So that definitely could be a way you go down the path. The other thing is, I think that to go to a completely passive ownership, the way I was sharing, I considered, I think it's very hard for someone like me who started from scratch. I built this baby. It's my baby. It's my husband, my baby, but it's my baby. And to completely walk away and somehow have somebody else managing it and you check on it in a month is hard. I do think there's some owners out there that may have purchased a small business, or they didn't start it from scratch for whatever reason. And it might be easier to passively manage it, right? It's just like psychologically hard when you did everything. I mean, it's hard enough just to take yourself out of the day-to-day. So that it just seemed impossible to me.
And I think what's relevant to this conversation is how you prepare for all those things you mentioned. How you remove yourself from a business allows you to consider these options, right? If you're no longer in the trenches and running it actively, you can consider, okay, now passing it to management. You can consider selling to a third party. You can consider merging the business. But when you're in this is one of the topics, is when you're in the trenches and you're in the daily operations, those options truly aren't available to you. And if they are available to you, it's typically at a discount, right? It's typically a lower valuation and a longer transitional period if you do actually decide to sell to somebody else.
Yeah. I mean, what we started saying is, okay, I have to get myself out of this business. It doesn't mean that I won't check email every day or check how revenue is going from behind the scenes, but I have to figure out how to make this business not a Sarah Bradford business. And so I would say at least 2 or 3 years, maybe 4 years I took to do that. And you have to, I call it depersonalization. Like you have to, and I think maybe I got that from Simon, you take yourself completely out of the day-to-day. And the most important part of that is you're taking yourself out of your homeowner relationships. And I know that's hardest for most of you, because most vacation rental company owners, the one sin they have of being involved in their company is being the homeowner contact, being the person that sells to new homeowners. And the best compliment I ever got about a year before we sold was a homeowner said, during COVID, I would record videos on the newsletter, which I stopped doing because they were seeing my face too much. And one homeowner said, who is this Sarah Bradford? And I was like, yes, that means they don't even know. Like I've taken myself out of that role.
That was a journey for you though. And the end result is great, but I remember having conversations around how that made you feel, like not being the most important person or not being the person that they went to and what other people thought. And so that, that journey I think is really important. There's not just the getting your business ready, right? Are you emotionally ready to go through that process of separating yourself from your baby, right? I mean, you built this from the ground up.
Totally. And you have to think about that. How's it going to feel after I sell? Do I care what people think? What do I want to be able to tell people? I mean, really, Jason, if I can jump to it, that gets to the importance I found and who we chose to sell to. I think everybody's all over the map on this. There's some people out there that aren't bothered who they sell to. I don't care who it is, just give me the money. I don't care. Well, that's not how I felt. I needed to be proud of who we sold to. I wanted a legacy. I wanted my staff to almost not feel it that I was gone. Maybe it would be even better for them. And I wanted to be able to tell my colleagues in the industry and also my neighbors, because I live in these towns, you know, I live in Steamboat and I lived in Winter Park. I didn't want to look like a sellout. And, you know, maybe I'm superficial for caring about that stuff, but that's why I had to go through the process of finding the right buyer.
I know that
Now,
was.
in terms,
Go
ahead, Jason.
Oh, please.
I mean, just going quickly back to this depersonalization. I mean, that sounds easier done than it actually, you know, than it's actually taking place. How would you, like, just being practical of what do you need to do of a buyer not believing that the entire business is dependent on you, and how much time does that take to get it to that point? So did that extend your process from when you decided with your husband, hey, we're going to sell this? Obviously that's expanded that duration quite considerably to depersonalize that.
Yeah, I mean, it took several years to depersonalize because if you started a company, you're probably a micromanager. You know everything about every little part of your business, and you probably have control issues. I for sure have control issues. So I had to, you know, my biggest piece of advice there I said, okay, if I went away to another country for a month, would this thing survive? And when I can get to that point, I know I've pretty much depersonalized, taken myself out of the business. But the other big thing I said to myself was, when I would see emails, especially, or be in meetings with staff, and they were discussing whatever issue or problem, keeping my mouth shut was a big one. And then if they asked me a question, I had the answer most of the time, or I thought I did, you know, instead of giving the answer, leading them to the answer or saying, what do you think? I mean, just that step right there empowers staff so much. But the other thing, Simon, is you have to have the staff to empower. So I'm finding there's some companies out there, many, who don't really have much staff. They're outsourcing a lot of the vacation rental business. We always had an in-house staff, cleaners, inspectors, maintenance, reservations, everybody was in-house. So we had a big staff. And I had built up some leaders in our business that I felt really comfortable with, who had been with me for a long time. So I had that advantage. You have to have someone at the head of your ship that is not you. And when you sell, the most value you can get is by saying, look, here are all the people. Like, the people is really a lot of what you're selling. These people are dedicated to our brand and culture and can live without me. And that's what I think got us the top value.
Sarah, on that, so a lot of times when we talk to business owners and they work on getting themselves out of the business, it makes life a little bit easier, right? Because you're not involved in the day-to-day action of the business. You're working limited hours, you're skiing every day. You're seeing the income from the business. You're like, well, why would I sell this? I've got it set up now that I could sell it, but I also could just live off of it. What was that turning point for you that you said, enough, enough's enough, and I'm ready to move forward with this process?
Yeah, I think a couple things. I'm a worrier. So even though I wasn't working in the business, COVID really sent shockwaves through me. I mean, I had already started talking with you, Jason. We had already decided we were going to sell. And then COVID hit. So that psychologically just was like, oh my gosh, for a month we thought we lost the business. I know that is stupid to think of now because we did so well, but that was very hard. And risk always scared me. Risk of people getting hurt, risk of homeowners suing, risk. I don't know. It became a stronger feeling than it had in the past. And the other thing is, we met with a financial advisor. in depth during that process. And because we didn't know what this amount of money meant or this amount of money, like I know what it means. And I kind of know after tax what it means. But at the time I was only 50, 51 years old. I'm planning to live, a long life. So is my husband. We have 2 kids in high school. They're about to go to college. They ski race. Ski racing's way more than college. And we were like, what does this amount of money mean? And are we going to be comfortable? Because one thing I said, and again, you have to realize my husband didn't have a different job. This was our income, right? I think it's different when it's like a side hustle of somebody's, but this was our income for 15 years. This is all we had. And I needed that. I said, I'm not going to sell if it doesn't mean I'm sitting pretty and not having to work. I am not going to sell this thing and then have to go get a job. No, right? I already have enough. I got it made. I'm my own boss. So when we met with the financial advisor, they went through detailed analysis with us on our needs, our budget, how we want to live, what we want to do in life. And they outlined what this would look like to us, certain price points. That way, when Jason and team came to us and said, these are the bids, we could be like, okay, that bid means that bid means that. And are we comfortable accepting it? If you just go sell your business because someone offers you $3 million, I mean, if you're young, that's not that much money. If you live a comfortable lifestyle,
Right.
So you really need to meet with a financial advisor to understand what you need to make.
Yeah, I remember that journey for you, Sarah, where we had conversations around, you and Chris had a certain number in mind, right? And we did evaluation for you. And oftentimes business owners fixate on a number, right? Because they feel like that's what they deserve or that's what they need. But the question I always ask is that enough? Or is that, like, if it's whatever the number is that enough to get you to where you want to go into retirement? And so that journey of, really diving into that and figuring out, and maybe the number that you actually need is less, and everything on top of it is bonus, right? Everything that you'd be able to sell the business for on top of that is just extra. And that took some time, right? I mean, so kind of back to the conversation about preparing your business. I mean, I think that journey for you was a couple months of trying to work through that with a financial advisor and really figure out if it made sense for you and Chris, or if you wanted just to continue to run it.
Yeah. I mean, really, to be honest, I had to get Chris comfortable with it because he's the worrier about the money. So he was able to see that. And every time he spazzed out that we were selling, I was like, remember what the guy said? We're good. Because it's very scary to sell your business and think there's no more income coming into when you're in your 50s.
And I think that's something, just going to the slide for 1 second, just to consider as we think about the different ways to transition out of your business. Knowing what you need and really taking the time to develop that strategy with a financial advisor allows you to consider each one of these components independently. And so if I need X amount, okay, can I achieve that with continue to run the business in a passive capacity? Or can I sell it to management? Or can I sell it to my kids? Most of the time, a lot of reality is the kids aren't interested in the business, but if they are, you're not maximizing value. So it's important in that preparation for your business is to really dive deep into your finances, get a better understanding with your advisors to be able to choose which option fits you best.
Yeah. And it was surprising to me how we didn't need as much as I thought we needed, because we are a bit older. And so there's lots of things that are, 401k, you can cash in on soon, Social Security. We have a lot of real estate. One thing to think about is real estate when you're selling your business. Can I talk about that for a second, Jason?
Absolutely.
Like, the financial advisor helped us with that, to say, oh, wait, you own 3 buildings for your business? Yeah. Are you going to sell those with your business? I don't know. Probably not. Most companies right now buying businesses, I don't think, are buying the real estate at that moment. And so then the financial advisor showing how we will be able to rent those buildings out, and that's income to us. I mean, it was pretty exciting, right? Because we just owned those 3 buildings to run the company. We weren't owning those buildings to make passive income. And if you do own real estate, which I highly recommend, be sure to get that all in check before you go to sell. I mean, one of the great things that Jason and team did for us is got us prepared in general. Like, he challenged us on our finances and how we ran the business more than any buyer ever did. And so we felt very prepared to go to market. And so with the real estate side, you got to make sure those are separate entities, make sure that's all set up correctly. So if you do sell the business without the real estate, that's going to be an easy transaction.
Yeah, absolutely. And that's a great kind of segue. There's two components to transitioning or selling a business. One is the business ready? Like, is the, operationally, financially, is the business management team, is the business ready? And then, are you ready? So let's stay with is the business ready? And Simon, I want to, turn this over to you a little bit. When you think about fundamentally the items that people should really consider and work on their business to make it really an exit ready business, whether that sell to a third party or not, what are those key characteristics that you look for when you advise a client on working on their business?
Absolutely. First of all, it's great what Sarah has started off with. For us, one of the first questions we're asking to the property managers we're working with, regardless of what their path of exit is going to be, or when they start considering, our first question is, how dependent is the business on you? Depersonalization, we call that now. This is a new expression to call it depersonalization, and say, okay, what happens if you go on holidays for a month and the business will fall down? So I think that's the first thing we want to hear and see in relation to structure, independence, who manages the relationship to the homeowners, who is at the key levers within the business, who makes the key decisions. You still make decisions, but the business needs to be able to run entirely without you in order to start the process. But apart from that, there's a couple of others. One I would put right behind it is financial hygiene. We are, in most cases, property managers, they're in this business because they love hospitality, and finances is just a pain in the neck that you need to take care of. And finding a good accountant sometimes can also be very challenging. Then you need to have trust accounting and many other things. You have VAT issues. And so I think having super clean books that will go against a very deep due diligence is absolute key. So how good is your financial hygiene, and not just for the last 12 months, but probably for the last 3 years. So financial hygiene, we can talk a lot. That's very important. And then when it comes to operation, somewhat related to depersonalization, obviously looking at the structure and what is the technology that supports that structure, right? So one thing that we definitely look at also in that moment is what the technology stack is looking like. Is that optimized in terms of productivity efficiencies for check-in, check-out purposes, operation reasons? From a distribution standpoint, have we got our business in as many channels as we can? Have we maxed out on demand generation, etc.? And then the last one I would bring in as a very important point is sort of profitability on a unit level, which is very much again related to the financial hygiene. It's not about how many properties you have on the books. It's like, what is the profitability per property? That's far more important. And going deeper into profitability will get you going immediately to look at the operational efficiency, because you can have properties that actually don't bring you a positive contribution or margin contribution because you just took it on, occupancy is low, you have a lot of problems with the property. So it's not just the unit count. I think we're looking deeper into gross margin, understanding what are the cost drivers within the business, and saying, what can we do to maximize profitability, even with running a leaner business, which will give you a higher valuation as well. So these would be the 4 points that we would look at.
And Sarah, that's great, Simon. Sarah, that's something that you did. You actually reduced your property count prior to going to market, because you focus truly on the bottom line. How do I become more profitable by doing less?
Yeah, I've seen way too many businesses that think they want to sell. They do a land grab. They just start taking all sorts of properties they wouldn't have taken if they were going to keep owning it. And owners they wouldn't want to work with, junker properties, as I like to say on the podcast. And instead, what we did, whether we were going to sell or not, we hadn't officially started the process of selling yet, but we looked at that margin contribution you're talking about, Simon, and said, man, we don't have a lot of people to hire in Winter Park, especially at the time. They're just it's a really limited labor pool. We can't be spread this thin. And we looked at our big fancy spreadsheet of which ones were profitable or not. There were about 50 we identified we want to get rid of. They just weren't pulling big money to the bottom line. So we went from 168 down to about 105. And we made more money that year. And that was a very sexy story, I got to tell you, because we were all happier. We had less work to do and we were making more money. So it's super important that you have properties that you have good relationships with the owners, but not with you specifically, and that are making good money. I wrote a couple other things down around that, Simon. You got me thinking budget. I was thinking brand and budget. So way too many vacation rental companies do not have a solid budget process, budget process, and they don't look at their P&L every month. You better get really comfortable with that before you start to sell if you want top dollar. I mean, all these things we're saying, like if you don't do any of them, you can probably still sell your business, but you're going to get like a 2 times multiple instead of good money. And so working on budget and then working on brand. Think about the perspective of the buyer. What are they coming in to buy? If they're just buying some properties they could have gotten to leave your program anyway and join their brand new program, why would they buy yours? But if you have a brand, if you have a high return guest pool, if you're not 100% dependent on OTAs for your bookings, but instead you have a funnel of guests that trust and love you, that is worth money. Also processes like you just mentioned, Simon. A buyer wants to buy a system. They want to buy not just your tech stack, and that is important, but that your tech stack works in some sort of automated or proven process, that your staff, if they leave, there's somebody else that could come in and do what you do. So processes are huge. And then the other thing I wanted to mention, which I feel really strongly about, is getting involved in the vacation rental industry. And right now everyone's like, oh, here she goes. But like, let's just take Miller Hawkins, for example. Miller Hawkins is running a big vacation rental company in Myrtle Beach. He hasn't sold it or anything like that. But about 4 or 5 years ago, he decided, you know what, I'm going to get more involved. So he eventually became the VRMA president. I don't know if his business has changed or not in 5 years, but if somebody was looking to buy a company in Myrtle Beach and he happened to be selling someday, they're going to go, ooh, it's Miller Hawkins. Like he must know what he was doing because he was president of VRMA, right? And when your name is known out there, it is worth money, guys. It's not just that you'll learn from everybody and they'll learn from you and it's a lovely experience, but you want to be known. If you're completely unknown and you go to market, you know, it's a little less trustworthy that you might have a solid business. What do you think about that, Jason or Simon? Do you guys agree with me?
I think reputation is critical, and oftentimes buyers invest in not just in the business and the people. And so being a thought leader and being, you know, entrenched within the industry does add value.
Mm-hmm.
I want to throw back that question in terms of value drivers to Jason. I think you've raised a very important point here, Sarah, but from a matter of seeing so many different businesses as well, Jason, on the verticals. And one that Sarah has raised is obviously this brand, you know, and I mean, this is a conversation on its own to talk about brand value in vacation rental, because there's a lot of different opinions, because there's businesses out there who basically have 0 direct bookings and they still talk about brand. But there's obviously brand value towards owners and there's brand value towards guests. But what other value drivers, Jason, do you see absolute key in a transaction like that?
Yeah, absolutely. And what we're talking about here is to drive value, is to give business owners options, right? Like Sarah said, you know, we could go find a buyer tomorrow for a business, but does that align with the business owner's goals for their exit? Does it create value and does it make for a smooth transaction? And so when I think about value drivers, And one of the things we've already touched on is the team. Buyers invest in people. They invest in teams. Preferably, they don't invest in you as the owner. They're investing in the team that you've built. And so how you've structured your team and how you've built the culture within your organization is critical when you're looking to sell an enduring business that, we're not just rolling up contracts into a larger strategic. Someone is buying your brand and what you've created. So focusing on culture, focusing on management team, even down to your team and how you structure that team, whether it's outsourced, housekeeping and outsourced maintenance, there's still an ability to create culture within that organization. So I would say that's critical. The other value driver you touched on as well, Simon, is and finances are the language of small business. It's absolutely critical to make sure that your books are in order. And if there's one thing that'll kill the opportunity to create value or kill an opportunity to close a transaction, it's poor books. So having the right bookkeeper, whether you're large enough to afford, CFO or someone full-time on your team, outsourcing that. There's some great options out there for fractional CFOs that can help drive strategy and really help you clean up your books. And then having the right CPA. All those work together in unison. And so having the right finances, if there's anyone that I would say is finances, right? Making sure your books are in order. And then the market that you're in, I think, plays a big role in the value of the business. Where are you located? What's the growth opportunity? What's your trajectory? Buyers invest in businesses with the opportunity to grow them and making sure that you're on, I had this conversation with my dad earlier. My dad sold his business, actually ended up buying it back and then selling it again. There's a whole nother podcast or webinar on that about, the emotional side of selling a business and like the lack of control once you do sell. But one of the things that he did is he sold on the upswing, and Sarah sold as her business was growing. And that is something that oftentimes business owners miss as they think about, okay, one more year, I'm going to maximize, and I'm going to take more money out of the business. One more year. And look, we don't know. There's COVID. I mean, who predicted a pandemic? There's a Great Recession. I mean, there's macroeconomic stuff that happens. You don't know. And so you do want to leave some meat on the bone for the buyer, and you do want to, as you're going up, businesses that are going up tend to sell for maximum value. So I'd say that's a big value driver as well, Simon.
That's a really good point. I just wanted to add to that, Jason, that I was thinking about how you have to make sure you have good finances, and you also want to have people that are in the right seats, and you can walk away from that. And when somebody might be listening right now thinking, I can't afford an accountant, I can't afford a GM, I would encourage you to say, okay, let's just say you're making, for easy math, $1 million profit. Take it down to 800 for a year, take 200 grand, go get those top management people that you can train and take over. You will get such a higher multiple that it will more than pay for that 200 hit you took for a few years. Do you follow that?
Yeah, absolutely. It's a great point.
Yeah.
So,
and the other
one thing I want to,
go ahead.
Yeah, go ahead, Sarah. Sorry.
I just wanted to say regulations about the area where you are. Is that what you were about to say, Simon? Regulations can come on quick and that can hurt you more than anything. So get in control and understand the regulations happening in your area and be at the table for that, because you might have a great business and then all of a sudden they're prohibiting vacation rentals in your space and your business just went down in value without you doing a thing wrong.
Yeah.
So one thing I wanted to come back, and this is super value points, Sarah, and thanks for pointing it out. I was too scared to throw it out there, but that's definitely one of the biggest threats we are also considering in the VR industry as a whole. So you need to be on top of that regardless, right? So, but going back to Jason, there's one concrete question related to what you said in terms of growth and projections. When you look at valuations, and we don't need to go down the whole of multiple ranges, etc. But people have also got the expectation that, this year we did X, but the next 2 years we're going to do X times 2. We want to be paid for that as well. And, when people are talking about valuation expectations, they're like, okay, yeah, this year is not a bad year, but next year we add another 40 properties and they're all going to come in Jan so we can fully maximize its occupancy, which they obviously don't because they come in seasonal. And then we want to be paid for the forward-looking numbers. And how is that being handled for the type of businesses as well when it comes to valuation?
Yeah, that's a great question. It really depends on the business. And, to answer one of the questions that's on the Q&A, the typical timeline to sell a business, once you've done all the work that, say, Sarah had done in her business, you look at somewhere in the timeline of, say, 5 to 9 months. Some businesses take longer, some take shorter, but that's the really run of a sophisticated process to where the whole goal behind this is to set up a competitive environment to give you options. You want people like competing for your business, and that timeline, it takes time to do that. So to answer the question from Ryan, it's typically 5, 6 to 9 months to transact. And Simon, on the question about valuation, if the business is set up well and it shows a growth trajectory and it's not just a blip, like we had a lot of just COVID blips, and then you're not showing post-COVID that you can continue to grow. One of the things that you can do is look, and you have to develop it, and you have to prove it, but look forward into a specific timeline that you want to close. So what we did with Sarah is we were very strategic about, okay, this is a seasonal business. You've got a winter and summer season with off seasons in the spring and fall. When is the best time for us to close? And then what are we going to be doing from a profitability standpoint the day that we close? And so we built a full model based on, okay, what does that look like? And we asked buyers to get to that point. And so when you think about valuation, you can capture some of that future value, but buyers are not going to pay you for 2 to 3 years down the road unless you retain equity in the company and you stay on and you work with them. You can participate in that future growth, but to be able to sell, walk away, majority of the time you're not able to really capture on that. That's the meat on the bone that I was talking about, Simon. You've got to leave something for the buyers.
Jason, that's great. And I know we have to do Q&A. I'll just add to that because there's 3 things we haven't talked about. I'm going to throw them out there. One is what you just touched on. You have to decide if you want to be involved in the company or not after. Do you want to have equity? Do you want to care how they do afterwards? And as far as not just your reputation, but monetarily, that was a big thing for me. And that's what I loved working with Jason and the crew about, because I said, I want to walk. I really feel like I want to be done because I like being my own boss. And, my husband in the next room will tell you I like being my own boss. And I didn't want to all of a sudden work for somebody. So when we were trying to decide on who to choose as the buyer, Jason came back to us and said, hey, Sarah, Chris, remember what you told me your goals were initially? You wanted to walk. And Sunset Management, Alan Rowe, who we sold to, they were up for us walking in a nice way. I mean, it was fine, but and that helped us decide that's the right buyer for us. So you really have to soul search whether you still want to be involved. Most people I know who have stayed involved, it was not pleasant in the end because you're watching someone else make all the decisions. The other thing we didn't talk about, Jason, was involving staff. A lot of companies I know don't tell their key staff that they're selling. I think that's really stressful for all involved. I involved our head of accounting and my general manager, and it was just so great. Like they knew we were going through this process for over a year, and I highly recommend it because they were bought into it. And then they showed the rest of the company that they were bought into that versus being shocked by the news and then having the next day to have to go tell the staff that we sold. And the final thing that's a quick, simple one, but we just didn't talk about it. If you go through the sales process of your company, make sure you have an incredible M&A attorney. We loved our attorney. Jason introduced us to him. When it gets down to the negotiating stuff and the legalese, it's pretty stressful. And you want to make sure you don't just have your neighborhood lawyer working with you. So I'll stop.
These are super valid points, Sarah, and straight put to the point. There is one more I want to throw back at Jason, also to you, Sarah, that I think we quickly want to look at from a Q&A standpoint is the valuation of contracts. One thing that is being always talked about, you said, you reduce your unit count because you could show a higher profitability. A buyer could see that you have 60% churn rate, which means you lost 60% of your supply. So this obviously has an effect. But what role, because you did a share deal, you didn't do an asset deal, right? So that means you sold actually the company and not just the assets of the company. And therefore, what role does the contract, the owner contract, play in terms of duration, in terms of owner lifetime value? How long has the owner been with you, and churn rate? Like, how did that come out in due diligence, and what did they look at in terms of your contracts? Jason, do you want to take that?
Are you pointing at me? Yeah, happy to take that.
I'm sitting on the other side.
Yeah, I mean, the bare minimum, and I know this has been talked about a lot in other sessions, it's just making sure that you have some assignability in your contracts. Not all deals are done as a stock deal like we did with Sarah. A lot of deals are done as an asset deal, and when you do an asset deal, you have to kind of assign those contracts over, and they have to sign up with a new entity. But yeah, the stickiness of your customers is a huge driver of value. One of the first requests that buyers give us when we go through a process with them is, okay, give me a breakdown of properties under management, what you've added, what you've lost, and what the total growth is over the last 3 to 4 years. And then the question is, why did you lose properties? And if you can tell the story like we did with Sarah, that like, look, this was strategic. These were not properties we wanted to manage, and they weren't profitable. That's a great way to spin it. The other part of that is if you're losing customers in contracts because you're not executing, that's a red flag and a risk for a buyer. So making sure you have a clear, articulate story about why how you added and who added them. Did they come to Sarah? Did they come to the team? And why did you lose properties? And again, buyers really want to see the growth, the growth in profitability, the growth in contracts, and also the stickiness. We can get into the nitty gritty, and I love this session because we could take any one of these topics and we could spin out to another 2-hour session just going through the nuts and bolts, but being very tactical. But just to keep it high level, just one word of advice is make sure that all of your contracts are up to date. They're all current. They're all executed. You have copies of all of them. And, hopefully they're all in the same template. The template's been reviewed by your attorney. And then that template has an assignability clause. And even better, as we discussed prior to getting on this call, is, a change of control clause in there as well.
Let's go to the Q&A. There's some good questions.
Yeah, the time is flowing by. We got some questions, and feel free if anyone wants to add any questions to the Q&A. Let's see. Matthew asked about EBITDA thresholds. So from a buyer's perspective, and value, like in multiples, are there thresholds that you can hit to increase attractiveness and also the multiple that you can get? And the answer is yes. As you grow, it's not just about increasing multiples, it's also increasing your buyer pool. So if you're a smaller company and you're doing $250,000 in profitability, you're only going to, and I'll take that a step further, you're only, you're entrenched in the business. Most likely that buyer is an owner operator, someone that wants the job. Right. So you only have a limited amount of people that you can sell to, and people that are buying jobs only pay low multiples. As you get sophistication within your business and you add management teams and you grow to that, he used the threshold of 500,000. Yeah, you start opening up another pool of buyers at that point, and then multiples start bumping up. sweet spot over $1 million in EBITDA. Really, you open up to a large variety of buyers, both strategic, private equity backed, individual buyers, and then the multiples definitely increase at that point. Sarah, question for you. How many of your staff stayed with the company?
Every single one. Yeah. And again, that was why we chose the buyer we did. Alan was not Alan, who owns and was Sunset Management, who now owns, I think, 5 companies, maybe 6 around the country. He didn't want to be the owner operator. So the whole point was, he was like, I don't even want it to feel like we bought this company. I want your staff to just keep on doing what they're doing. Owners don't notice a difference. Nothing's going to change. And that for me was really refreshing. So every single staff member stayed. And I mean, there's been attrition, like normal attrition, but the leadership is still there.
Yeah, and that's a testament to you and also to Sunset and their management style. Let's see. This is going back to Heather asked about, and we were talking about building teams, and she asked, what are the options, suggestions for those that are outsourcing cleaners and maintenance? Maybe Simon, do you have a opinion on this? As you build your team, as you kind of work on your business, if you're outsourcing some of the services, how do you continue to add value there or prepare for an exit?
Yeah, I think this is a too large topic to discuss, because it really depends on the type of business that you're operating and where you put your focus. I mean, Sarah said, I want to have more staff. I want to have everything in-house. I think there is no golden rule in what is best. I think if you take it down to operational efficiency, guest experience, etc., I think you can run with an outsourced model equally as well as with an in-source model, or a hybrid thereof. And I think one thing that we see most common is hybrids, where you have cleaners in-house and you have externals for the peaks, for seasonality, etc. And even with laundry, it's the same. So I don't think there's a golden rule also in relation to exit what is best. I think it's about operational efficiency, cost efficiency, that drives what you have in-house and what you have external. And some do it better with internals, and some don't have the service providers, so they can't outsource, so they need to do in-house, and they would rather outsource. So I think there is not a golden rule here.
Yeah, I will say one thing is just one thing to think about, and one of the things we work through is just diversification. So you want diversification with your customers. You also want diversification with your suppliers and your vendors. So having a backup, if you are outsourcing to a housekeeping company, what happens if that relationship falls apart, and how does that impact your business? So having a second or a third option and having those conversations, you may not have to use them or may use them part-time, but that is a risk to the business. And if you can mitigate that risk, that obviously makes your business more attractive. Other questions? Exit strategy, an ESOP. Yeah, absolutely. That's definitely a strategy that it's not something that we do personally. We have great advisors that focus on ESOPs, and we've seen a good amount of businesses do ESOPs and do them well. I'm not sure of any in this industry specifically that is executed on that strategy, though.
Can you explain to the common man what ESOP is?
Yeah, it's an employee stock option program. So you're basically selling to, thank you. You're selling to your employees, and you're getting paid back over time through some options. What are the multiples of small businesses, $250,000 and less? I mean, the multiple for a business like that, I assume that's profitability and not revenue, but I would say off the cuff, depending on the business, somewhere in the 1.5 to 3 times range, depending on the business. Did the owner commit?
Lisa Farrow's. Go
Say
ahead.
again?
Lisa Farrow asked, what if she owns a decent amount of the properties?
Yeah, this is actually something that's become more and more prevalent as the industry has evolved, and there are a lot more institutional investors looking to get into the space to own the assets. So people, and what I mean by that is there are buyers out there that also want to buy the real estate. So if you do own the real estate and associate with owning your management company, there's two options. One is selling just the management company and you maintain the real estate and the company continues to charge you a management fee, or you could potentially look for an investor that is interested in owning the real estate as well. And then you would actually sell the real estate as the value, the real estate value. I will say
she means she owns the properties.
That's what I mean.
Okay. Do you think there's buyers out there that would buy the properties too?
I had a conversation yesterday with a fund, the company that just raised $100 million to roll out a strategy to buy the real estate assets and manage them themselves.
Okay.
It's definitely an emerging strategy, very much like multifamily and commercial real estate. Valued differently, but yeah, definitely a strategy that some people are taking. I will say, was that Lisa? Lisa, one thing to consider, if that is the case, making sure that your real estate and your business are in two separate entities, and make sure on your books for your business, you're charging the real estate company the right amount of management fee. So you want to make sure all that is reflected in your books appropriately. So it is kind of a third party, separate, two separate entities.
Mm-hmm. Jason,
I want to pick up on a question that Ryan has asked about the buyer universe, which I think something we haven't covered yet. Who is ultimately buying a property management company? And sorry, Sarah, if I cut you out, but I thought that was quite interesting. The question is, do you find that buyers tend to already be in the same market as you, or are buyers typically coming from outside the markets? I think one thing that is definitely changing over time, that we have seen classical with roll-up strategies like Vacasa has triggered very early in the space, and now also V-Trips and others. I think the roll-ups or the way acquisitions are done and the buyer universe, we call it, has fundamentally changed. And one thing was a really big observation when Jason and I attended VRMA Vegas last November is that we have never seen more private equity firms at VRMA than last year. It was absolutely incredible. So this question is a very important question, because we have to differentiate between different type of buyers. So we call strategic buyers the ones who are already in the vacation rental business, who want to expand into new markets or in existing markets. I think we see both. But then we have a lot more financial buyers, or we call them financial-backed strategic buyers, which private equities are behind, and they want to roll up. Markets like Village Realty, we have seen doing private equity-backed roll-ups as well. And I think that is now fundamentally changing. So the vacation rental industry at large has attracted a lot more capital. Also, what Jason alluded to, even owning assets. So one thing that definitely has changed in looking at an exit process is that the buyer universe is not your classical business from Oregon or from Florida. It's actually, it is now changing fundamentally. And I think that's another reason to actually work with an advisor who knows the market very well, because when you take a business on, you actually have no clue who would end up buying this. And a few years ago, it was pretty obvious who would buy it. Now, you need to put a lot of work in defining your buyer universe to make sure you get the right people who are interested in this asset.
Yeah, I'd like to finish up with a comment on that. Please, I want to advise everybody to not just take the first person that comes along. Someone says, hey, let's do a backdoor deal. I know someone that wants to buy your company. Probably not the best thing. Get comfortable with your budget. But the other thing is what you said, Simon, is there's these investors that don't know anything about the vacation rental industry, and then there's strategic buyers that are already in it. One thing I love about who we sold to, Sunset Management, Allen Rowe, is they already owned 4 companies. They knew what they were getting into, and they didn't need me to stay. If you go with someone that's brand new in this industry, they're going to be needing you, the expert, to stay on. And unless you want to do that, you got to be a little weary.
Yeah, those are all great points. And I know we're at the top of the hour and appreciate everyone staying a couple minutes long. I think we could do follow-up sessions from here. There's so many topics we could dig into, but we are out of time. Sarah, Simon, this has been a pleasure. It's great to see you both again. As a follow-up for everyone, we have recorded this. We're going to send out an email to everyone. We're going to put our heads together, some key takeaways, and send those out. We'll also include a recording, and our contact information will be on those emails. So if anyone wants to have a follow-up conversation, we're happy to dig in a little bit specifically about your business. Thanks again. Really appreciated it.
Bye.
Thank you, everyone. And please do not forget, we are at VRMA Kansas City. Come and see us at our booth. Take care. And thank you, Sarah.